Hey, hi everyone. Welcome to another video in our option selling positional trading adjustments series. So today we are going to discuss this positional protective put and positional protective call strategy in Indian index markets and the adjustments that could be done for the positional protective put and the positional protective call strategy. Okay, and various scenarios and examples we will go through from Nifty, Sensex, and Bank Nifty, and adjustments that could be done for both positional protective put and protective call. Okay, so protective puts and calls are the core tools for positional trades on Indian indices, and these are used. The protective puts and calls are used by big institutions also, and that's why it's called as a core tool for positional trading in Indian indices like Nifty 50, Bank Nifty, and Sensex. And the primary aim of this particular strategy is to hedge the long as well as short index positions with defined risk. So you have a view that if either a bullish or a bearish view you have, and you want to hedge your position in case you go wrong. You want to only have a certain defined risk. So that's what the primary aim of this particular strategy is, and this is a core strategy for many big companies. Okay, so again, what is a protective put? Okay, so protective put is the buying the futures or long going long on the equity, and buying a put uh, to hedge the downside risk. So that is called as a protective put. The market view you will have is bullish and long position you will have. So when your view is bullish and long, you buy a futures or long go long in a stock, and then you'll buy a put to protect yourself from downside or hedge yourself from downside risk. That's called a protective put. Protective call is the opposite of it. So when your market view is bearish or you have a short position. Okay, that short position you can only have in futures. Okay, not in equity unless you are doing it intraday. But yeah, this short position is for futures. So when you're shorting futures of an equity, and your view is bearish, but you want to protect yourself or hedge yourself against the upside risk, you buy a call. Okay, so that's what these two things are there, and these are equivalent to insured future position. So if you're insuring your future positions and you are paying a premium to cap your loss, it's like a insurance for your futures position, so that you don't have a you hedge yourself against unlimited risk, and you cap your risk to a defined risk. Okay, so example based setup protective put is scenario. You're bullish on Nifty that if, for example, 23,000 spot, you go long on one Nifty futures. Lot size is 25, it seems. This is example. Okay, so Nifty futures, I'm not sure whether it's 25 or 75. Options I know, option lot is 75, but futures we don't know. So let's assume for the sake of example that you are bullish on Nifty, and the Nifty spot is at 20,000, 23,000. You go long one lot on Nifty futures, and let's assume the lot size is 25. You buy this one lot of Nifty at 23,000, and then what you'll do is you buy one lot of Nifty 23,000 put, okay, at 200 rupees. So futures margin is 1.2 lakhs, and put cost is 5,000 rupees. Uh, okay, so this is assuming the Nifty lot size to be 25. Even options lot size it's assuming to be 25, which was it is not the case right now. It is 75. But yeah, let's go with the example. Okay, so max loss in this case is 200. 23,000 put you purchased at 200, and 25 is the lot size, so 5,000 is the put premium you have given. That's a max loss you will have, but unlimited upside you will have. Okay, so if Nifty rallies, put expires worthless, but your futures will gain. Okay, and you will achieve break even when the market is at 23,000 spot, right? If it moves above 23,200, you will achieve a profit. Okay, so that's the thing. Okay, so let's see the adjustments that could be done for a protective put. So rolling up or down the put. So if market moves sharply, you can roll the protective put to adjust protection. So market rallies to 23,800, for suppose. It is at 23 and it rallied to 23,800. So your futures will be in huge profit. Your long futures are in huge profit, but put will lose value uh, and you can book the loss on the put and take the profit in the futures. And if you want to still hold with the further upside moment you're expecting, then you can buy a higher strike put and close this old put for renewed protection. Okay, so that's what it is. So example is you sold 23,000 put at 20, you buy 23,600. Okay, this locks in your gains and again you will have a downside insurance. So when market rallies up, you will be in profit. So take the profits, close the put position, and if you want to hedge, if you feel that the market will go up again, take a higher strike put. Okay, Nifty falls to 22,400. So this is what we have taken that hedged position. So your futures will lose money, but put will gain, and you can book the profit on the put and okay, and buy a lower strike put to maintain the hedge. If you feel again that the market is still going to be bullish only, but it's just it just went it is retracing or whatever, you feel like it's only a temporary thing, then you can take the profit book the profit on the put, and you can buy a lower strike put. This protects you from further downside and locks your profit. But if your view is changed, then you exit the position. Okay, that's what you do. Okay, uh, or you can just put the put like that, and you can exit the futures position if you feel if the market is going to go down. Okay, and the next thing is converting to collar. Also, you could do if market becomes range bound, you want to reduce the premium cost, then you could convert it this protective or put into a collar by adding a short OTM call. Then it becomes a collar. So you long the Nifty futures, you bought a 23,000 put, you will sell a 23,600 call also. This will reduce the net premium to 100, whatever you are giving, and downside is still protected, upside is capped at 23,600. This is great for sideways to slightly bullish expectations. Callers are good for slightly sideways to slightly bullish or sideways to slightly bearish positions. And this collar you can convert when the market is range bound. Okay. Partial hedge using weekly options. In volatile weeks, instead of buying a long term put, you can buy weekly puts when VIX is low. Okay, when VIX is low, you buy a weekly put, and when VIX is high, you sell a weekly call to finance the put cost. Ratio hedge adjustment. If volatility increases after entry, you sell an extra OTM put to reduce the cost. So you went long on Nifty, one lot of put you have bought, one sell one lot of 22,500 put also to reduce the cost. This is used when expecting mild correction only. Downside is limited until 22,500. Below that, risk increases. Okay. Yeah. So now coming to the protective call. Protective call is exactly the opposite of protective put. So you will short the index future, and you will buy a call to protect from the upside risk. Okay. So example is you short Bank Nifty 50,000, and you buy 50,000 call. Okay, loss is capped beyond 450 300. Profit is unlimited on downside. Okay. Yeah. So you'll have profit unlimited, and loss you'll have capped. That's the main beauty of this particular strategy is adjustment. So if Nifty falls or Bank Nifty falls to 48,000, your futures will gain. You'll gain like 30,000 in this example. Call decay, and you can just remove that call and sell another call to recover premium or roll down the protection. Okay. If Bank Nifty rallies to 51,000, so this is against your view. Future will lose, but call will gain. Okay, so you can book profit on the call and roll up the call to a higher strike. If your view is still bearish only, you can do that. Or if your view changes to bullish, then you can remove the future and just put the call. Okay. Converting to a bear collar. So this you will do when the market is again sideways. So you will short a futures plus buy ATM call plus sell a lower put. This is for range bound markets. This creates an income style hedge that limits both sides modestly. Volatility, market condition, low wicks less than 12. You buy puts that will be cheap insurance when volatility is expected to rise. Okay, reason when high wicks volatility is greater than 18, use collars or ratio spreads. Okay, expensive options and reduce the premium cost. Trending market, roll up or down the protection, maintain dynamic hedge. Range bound, convert it to a collar. Okay, and theta and protect downside. So these are the different adjustments for protective put and a call. I think we went through the examples. There are advanced adjustments also, like a calendar hedge we can do, buy monthly put and sell weekly puts against it. It will help you to earn theta and keep protection. Synthetic futures conversions you can do. Long call plus short put is futures. You can unwind partially by closing one side if sentiment changes. So dynamic delta neutral adjustment you could do. Use 2 to 3 strike options to maintain near zero delta exposure and positional setups. So summary of adjustments is adjustments are roll up and down. This is used when market is moving strongly. uh, okay, and this will keep your hedge active. A collar when a range bound market you can do to reduce the cost. A ratio hedge, mild move when you're expecting to save premium you can use. Calendar hedge you can use when high IVDK is there to earn theta. Partial hedge adjustment you can use when volatile events are there and you will have the lower cost here. Close plus re-enter is sharp reversal, book profits and reset. Okay, so that's it for today, guys. Thanks everyone. Have a nice day. Bye.